On a Saturday in January 1951, a 20-year-old Warren Buffett took a train to Washington, D.C. His destination? The headquarters of a company called the Government Employees Insurance Company, or GEICO. Buffett's mentor, Benjamin Graham, the godfather of value investing, was on GEICO's board. When Buffett read about this company in Graham's writings, he was intensely curious. What kind of business could earn such admiration from his idol? When he arrived at GEICO's headquarters, the door was locked. Buffett knocked persistently until a janitor finally opened the door. The janitor told him someone was still working on the 6th floor. Buffett went upstairs and met Lorimer Davidson, the company's financial vice president, who was working that Saturday. Davidson was impressed by this young man's curiosity and insightful questions. He spent 4 full hours giving Buffett a crash course in the insurance business. Years later, Buffett wrote in a Berkshire Hathaway shareholder letter, "If Davy hadn't been so generous with his time on that cold Saturday in 1951, Berkshire wouldn't be what it is today." Those 4 hours changed Buffett's life. During that conversation, Buffett grasped 2 revolutionary concepts. First concept, the power of selective underwriting. GEICO wasn't like other insurance companies that accepted anyone. Founded in 1936 by Leo Goodwin, it only sold auto insurance to low-risk groups like government employees. Why did this matter? Because government employees were typically well-educated, held stable jobs, followed the law, and had accident rates far below average. Buffett realized, an insurance company that knows how to reject bad customers will be far more profitable than its competitors. Second concept, the magic of float. Think about a restaurant's prepaid membership card. You pay $10,000 to join a restaurant's membership program. The restaurant promises to provide $10,000 worth of meals in the future. That $10,000 immediately goes into the restaurant's account, but you won't consume it all today. It might take 6 months or even a year to use it up. During this time, the restaurant can use that $10,000 to buy ingredients, invest in equipment, or even earn interest at the bank. When you come to dine 6 months later, the restaurant only needs to pay the actual cost of ingredients and labor, maybe $3,000. Insurance float works the same way, but on a much larger scale. Customers pay premiums today, but claims might not happen for months or even years. During this period, the insurance company can invest all those premiums. If invested wisely, they can both cover future claims and generate additional investment returns. This is the dual profit machine. Underwriting profit, premiums minus claims minus costs. Investment profit, returns generated from investing the float. And GEICO's model was even better. It sold directly by mail to safe drivers, government employees, without expensive insurance agents. This meant its costs were much lower than competitors. Low cost is a moat. Float is a superweapon. After returning to New York, Buffett made an extremely bold decision. He invested 75% of his life savings, about $7,500, into GEICO stock. This represented 65% of his net worth. For a 20-year-old student, this was an all-in bet. A year later, the stock was up 50%. Buffett sold all his shares, making a profit of about $5,000. For a student, this seemed like a brilliant victory. But over the following decades, GEICO stock price soared. Buffett reviewed this decision countless times, calling it incredibly stupid. He had sold a stock he completely understood, one with enormous competitive advantages. This departure from his first love taught him a hard lesson. For truly exceptional companies, the power of long-term holding far exceeds any short-term trade. Speaking of GEICO, we must mention Buffett's mentor, Graham. In 1948, Graham's investment firm purchased 50% of GEICO for $712,500. By 1972, this investment had grown to $400 million, a 562 times return. Graham later confessed in The Intelligent Investor, "The profit from this one GEICO investment exceeded the total of all my other investments over 20 years. Ironically, this investment violated several of Graham's own rules. including never holding more than 5% in a single company. GEICO represented 20% of his portfolio. Graham's reflection was profound. One lucky break, or one supremely shrewd decision. Can we tell them apart? May count for more than a lifetime of ordinary effort. Fast forward to the mid-1970s. America was trapped in stagflation triggered by the oil crisis. For GEICO, this was a perfect storm. The oil crisis caused car repair and medical costs to surge, dramatically increasing claim amounts. Due to regulation and competition, premiums couldn't keep pace. Chasing growth, GEICO started selling insurance to high-risk groups, young drivers and those with accident records, at discounted rates. The result was predictable. Claims flooded in like a tsunami, and the company posted massive losses. The stock price plunged from $61 per share in 1972 to just $2 in 1976, a drop of over 96%. The former star stock had become junk. In the midst of this apocalyptic scene, what was Buffett doing in Omaha? He wasn't selling. Instead, he was carefully reading GEICO's financial statements and insurance manuals going back decades. What he saw, the moat was still intact. The core business model focused on low-risk customers remained sound. Management had just made mistakes. Massive margin of safety. At $2 per share, the stock traded far below even the most conservative estimate of the company's intrinsic value. Classic scene in investment history unfolded. When everyone else was running for the exits, Buffett started moving upstream. Starting in 1976, he calmly and consistently bought GEICO stock through Berkshire Hathaway, purchased $4.1 million in common stock, purchased $19.4 million in convertible preferred stock. By 1980, he had invested a total of $45.7 million. At an average price of about $3.18 per share, he acquired approximately 33%. Buffett became GEICO's largest shareholder. But Buffett did more than just provide capital. He had Berkshire provide reinsurance for GEICO, essentially insurance for insurance companies, helping spread the risk. Buffett personally called regulatory officials to buy GEICO precious time. At the time, Wall Street banks refused to underwrite this troubled company. John Gutfreund of Salomon Brothers heard Buffett was involved and had analysts research GEICO. When Buffett promised to backstop the capital raise, Salomon agreed to underwrite. In August 1976, Salomon helped GEICO raise $76 million through preferred stock, sending a powerful signal to the market. If Buffett's investing, this company might survive. With Buffett's influence, GEICO appointed a new CEO, John Byrne. After taking over, Byrne decisively executed Buffett's strategy. Stop the bleeding immediately. Massively cancel policies for high-risk customers. Return to core. Refocus on government employees and other low-risk groups. Raise premiums. Realign pricing with risk. Cut costs. Rebuild financial health. The moat was redug and reinforced. Soon, GEICO returned to profitability. By the end of 1976, the stock had risen from $2 to $8, quadrupling in value. Sadly, Graham passed away in September 1976 at age 82, never seeing his protege bring GEICO back to life. Two key figures, investment genius and operations master. Lou Simpson, the hidden legend. As GEICO's Chief Investment Officer, or CIO, Simpson's investment performance was stunning. Over 25 years from 1980 to 2004, average annual return, 20.3%. S&P 500 over the same period, 13.5%. Beat the market by 6.8 percentage points for 25 consecutive years. Only 3 negative years out of 25. Beat the index 18 times. In 1986, Simpson beat the S&P 500 by 20 percentage points in a single year. Buffett praised his abilities in his shareholder letter. When Simpson retired in 2010 at age 74, Buffett called him one of the investment legends. The real operational helmsman of GEICO was Tony Nicely. In 1961, 18-year-old Nicely joined GEICO as a clerk, initially just trying to save money for college. His career trajectory was legendary. 1973, Assistant Vice President. 1980, Regional Vice President. 1985, Senior Vice President. 1987, Executive Vice President. 1989, President. 1993, Chairman, President, and CEO. After Nicely took over, he launched the four-company strategy and dramatically increased advertising spending, giving GEICO national recognition. During his tenure, GEICO became America's second-largest auto insurer. Buffett said Nicely's leadership added over $50 billion in intrinsic value to Berkshire. On August 29, 1999, a legendary character was born in GEICO's advertising history, the GEICO Gecko. The creation story was full of drama. At the time, the Screen Actors Guild was on strike, making it impossible to use human actors for commercials. Meanwhile, the marketing team noticed many consumers mispronounced GEICO as gecko, so they created a green gecko with a British accent to correct the brand pronunciation. Unexpectedly, the gecko became a sensation. Over 150 commercials have been made to date. In the gecko's first year, 2000, GEICO generated $5.6 billion in sales. By 2003, this grew to $7.8 billion. By the mid-1990s, GEICO had fully recovered, once again becoming a strong and profitable company. In 1996, Buffett decided to completely acquire GEICO, buying all the shares he didn't already own. At this point, his original investment of $45.7 million had grown to approximately $23.93 billion. In 15 years, a 5,136% return, with annualized returns exceeding 30%. And this doesn't include decades of continuous dividend income. As a wholly owned subsidiary of Berkshire, GEICO's profits contributed massively to Berkshire's overall value. Buffett's life teaches us, investment success isn't about predicting the future, it's about sticking to principles. It's about having the courage, based on facts and understanding, to bet big when the world is panicking. It's about having patience beyond the ordinary to nurture a great business as it grows. The GEICO story is far more than a wealth legend. It's a perfect case study of how knowledge becomes cash flow. Buffett often says, "Find the wettest snow and the longest hill." GEICO was that wettest snow. And the 70-plus years from 1951 to today is that longest hill. When the snowball rolled to today, it has become a multi-billion-dollar giant enterprise. And it all started with a 20-year-old's weekend adventure. Truly great achievements require time to nurture.